In this video, we are going to be analysing NIO because it was requested. So to get straight into it, we're currently sitting just below $9 at $8.95. We're up about 0.5% on the day. Now, what are key levels? Because they did recently have their earnings and this was taken relatively bullish, and we have started to push to the upside. So with Mullen, one thing I want to know, with NIO, first things I want to point out is firstly, what's it doing? On the 6 month, it is in a strong downtrend. On the 1 year, it's in a strong downtrend. Whenever we see this, I'm always going to be more short bias on it because I like to trade with the overall shorter and longer term trends. So in a case like NIO, my main focus is on its short bias. And just to quickly note, if you're looking at supports where we would be long bias, it's going to be below this 740. This is considered fair value. So if we're looking at it from an investment standpoint, we want to get in at 740 or below. If we're looking at it from a trading perspective, then really the first level I'm looking to buy is around 533. So, would require us to push even lower below that 52-week low. So again, if I'm long bias, that's my level. But my main focus on a stock like this, considering it's more of a downtrending stock, is to trade at short bias. And again, we have these levels ready that we're focusing on. So the first two to be noting is 960 and 1045. Now this is the first deviation on the 1 year and the first deviation on the 6 month. And again, if you watch this channel, whenever we got dash line, that means 6 month. If we got the solid line, that's a 1 year chart, just so you know. But these two levels are key because this, again, when the stock starts coming into this value, it is considered overbought, and the majority of the time you start to pull back and then you trade back down to its fair value, which in this case is 740. Now, you're always taking more risk on there when you trade these first deviations because you're not as likely to pull back as you are from this blue deviation. Reason for that is, again, first deviations is 68% of data should trade within. So if we start coming into this area, you're still going to have about 30% of data that trades above this value. Or 15%, because you should have 15% on the downside as well. So as soon as we see that, what I prefer to do is be more patient on these stocks, wait for that second deviation, because that's 95% of data. 95% of data should trade within its second deviation. So knowing that, if we start to squeeze, we kind of hesitate at this level, then we push further to this 1175. I know there's a high probability that we start to turn bearish and we start to reverse coming into this level. So a lot of times, again, I will use defined risk strategies, whether that's shorting the shares, buying calls, buying puts, or just using vertical spreads when we come into this level above, because I know more than 50% of the time it's going to fall in price. And on a lot of these, we can get a 1-to-1 risk to reward. So, or again, usually worst case 1-to-1 risk to reward. So it does mean even if, say, we've got 60% accuracy, which again, we definitely have higher, but at 60%, on a 1-to-1 risk to reward, it's still going to be a profitable strategy overall. So that's my main focus is, yes, we have these two levels. If we want to trade them again, we potentially use a bit less size or just look at them as day trading levels, which is probably how I'll look at these two. Now, if we start to break that and we come to this 1175, this is where I'm looking more for those swing trade opportunities. Again, playing the options that we talked about before, probably looking to do the covered shares, meaning we short the shares, buy the calls, or we're probably looking to do some vertical spreads. The reason I like trading that instead of the outright put is then you're not getting affected by the time decay, or at least nowhere near as harsh, and you can kind of pick a time in the future when you want to be out. Yes, you can do that with the put, but then you've got to account for implied volatility, time decay, and there's a lot of things which kind of need to go your way for it to work out right. Whereas the vertical spreads of the covered stock, you more just have to get the direction right in the time frame you state. So those are the three main levels I'm paying attention to as resistances. If we start to break that 1175, then we'll make an updated video. And again, if you're a long bias trader, usually when I talk about this, I'm talking this more as a reversal standpoint, because that's how I trade. I'm a reversal trader. But if you're a trend trader, then these are just going to be used as targets. Definitely looking in profits into these areas and moving stops or trading your stops coming out of these levels. Because 9 times out of 10, you get a pullback off these levels, but it's whether that pullback turns into an overall reversal or just a temporary pullback and we continue higher. So that's what you want to figure out, is where you want your stop, because where do you consider that a pullback or a reversal? Thank you for watching. If you enjoyed the video, you will probably enjoy this video too.